The IEA just announced a 900 million barrel oil deficit, and Morgan Stanley says the S&P is hitting 7,500 anyway. Here is the math that proves one of them is wrong.
Right now, we are staring down the barrel of a frankly staggering physical reality. The International Energy Agency's latest data points to a massive 900 million barrel cumulative oil liquids deficit projecting out to September 2026. Look, this isn't just some minor supply chain hiccup. We are literally talking about drawing down the world's absolute energy insurance at a record pace.
But then, you look over at Wall Street. JP Morgan and Morgan Stanley are out here projecting these exuberant double-digit percentage returns for the stock market. They're targeting the S&P 500 to hit around 7,500 by year-end. And honestly, some strategists are forecasting even bigger gains than that.
So we're looking at this deep, undeniable cognitive dissonance. On one hand, you've got the severe physical constraints of a collapsing global energy supply chain. But on the other hand, Wall Street is projecting massive corporate earnings expansion. The math dictating the physical world and the math dictating the financial world, they are completely decoupled right now.
And the catalyst driving this physical constraint is this: 14.4 million barrels per day of output from Gulf countries, just lost relative to pre-war levels. This is directly tied to the closure of the Strait of Hormuz. To put that scale into perspective, that is roughly 20% of the global energy supply effectively locked out of the market.
Now, before we go any further, a standard but absolutely crucial disclaimer. The data we're reviewing today involves extreme geopolitical volatility and rapidly shifting market risks. This explainer is strictly an objective analysis of current institutional data and macroeconomic reports. It is not personalized financial advice. Please assess your own risk tolerance carefully.
Okay, let's dive into this. When we look at the IEA's May 2026 oil market report, the physical constraints are absolute. Since hostilities began in February, we've seen an unprecedented total cumulative global supply loss of 12.8 million barrels per day. Again, to put that into perspective, removing that much volume from the market is roughly equivalent to eliminating the entire output of the world's second-largest oil producer, overnight. This really illustrates the structural rupture we're facing. Check this out. The IEA's pre-war forecast expected a comfortable global supply surplus of 0.41 million barrels a day for 2026. Fast forward to the May forecast, and boom, we are staring at a massive 1.78 million barrel per day deficit. Because of this massive swing, global observed oil inventories are just bleeding out fast. They drew down 129 million barrels in March and another 117 million barrels in April. That is well over 100 million barrels vanishing every single month.
The rapid-fire consequences on the downstream industrial base here are severe. Refinery crude throughputs are forecast to plunge by 4.5 million barrels a day in the second quarter alone as operators desperately scramble for feedstock. And the sheer mathematical hurdle of recovering from this is just staggering. Even if the Strait of Hormuz magically reopens tomorrow and the market achieves a sustained 1 million barrel per day surplus, the IEA estimates it will still take a full 3 years just to rebuild these depleted strategic and commercial reserves.
Section 1. The Financial Disconnect. AI CapEx versus Physical Reality.
So, we have a physical energy architecture in deep distress, right? But here is the financial paradox. On one side, you've got this severe energy deficit. On the other, analysts are projecting 14 to 16% annual earnings per share growth for 2026. How does that make sense? Well, it's the AI CapEx boom. Wall Street is betting so heavily on generative AI investments and massive productivity gains that they are effectively looking right past the collapsing physical supply chain. The optimism is so absolute that recession fears are practically non-existent in their financial modeling.
Now, what's really interesting about JP Morgan's data here is how markets are actually pricing in these compounding risks. Wall Street is heavily relying on what's called a Fed Goldilocks scenario, moderate upside with lower real rates. But notice how, when optimism becomes the total consensus, the market gets extremely brittle. With expectations running this high, any misstep in earnings or, frankly, any further geopolitical shock could trigger sudden multiple compression and outsized market reactions.
Section 2. The escape valve. The gold rotation.
Okay, so if equity markets are brittle and fiat currencies are facing structural inflation from this massive energy shock, we really need to look at exactly where the smart capital is fleeing to. Where are they going to hedge this extreme volatility and ongoing de-dollarization? Well, ground yourself with this number. JP Morgan has made this their absolute highest conviction long, projecting that gold will average an astonishing $5,055 an ounce by the fourth quarter of 2026. And this isn't just retail demand. This is being driven by central banks buying an estimated 566 tons every single quarter. They are scrambling to find independent alternatives to the US dollar. And you know what? It could go much higher than that. JP Morgan actually modeled an aggressive diversification scenario. It revealed that if foreign asset holders shift just 0.5% of their total holdings correctly into physical gold, it would generate enough sudden new demand to violently drive the price to $6,000 an ounce. Think about that. Gold is shifting from your standard inflation hedge to an instrument of pure geopolitical sovereign defense.
To keep getting these direct, data-driven breakdowns of the global macro environment before the broader market even prices them in, make sure you subscribe right now.
Section 3, the delayed payoff, the normalization trap.
So the crucial point is, how are major institutions, governments, and massive corporations getting caught so completely off guard by these compounded shocks? Well, Control Risks named this psychological blind spot explicitly in their Risk Map 2026 report. They call it the normalization trap. It's this structural dynamic where institutions basically calibrate their risk tolerance to the volatility they've already survived, things like COVID or previous supply chain fractures, and then they just stop recalibrating. They completely mistake their habituation to chaos for actual, genuine preparedness.
Crisis communication specialist Felipe Boromans actually summarizes this perfectly. He says, "The normalization trap closes when organizations mistake their ability to cope with the past for preparedness for the future. The global environment just keeps shifting and cascading, but corporate risk calibrations simply do not. They sit there thinking, hey, we handled the last crisis, we can definitely handle this one, completely missing the fact that the new baseline is structurally different."
Listen, the single event crisis plan is dead. In this fractured global architecture, today's risks are concurrent. You aren't just dealing with a supply chain shock anymore. You're simultaneously dealing with what they call activated societies, targeting specific companies over geopolitical alignments. You're dealing with AI disinformation, like those AI fabricated videos of missile strikes that racked up over 100 million views on X before anyone could even intervene. The complex interaction between these compound crises is exactly where legacy plans and traditional portfolios break down.
To really understand the specific geopolitical policies accelerating this global fragmentation and driving these wild market reactions, check out our next explainer, the Donroe Doctrine Explained. Go ahead and click to keep learning.